have people joining. I know it's 10 o'clock right on the dot, so we're giving people a little bit of time to join. We're so excited about our guest speaker here today, Jonathan Greene, and we've got a lot to talk about today. So again, the reminder is to level up. We don't just help our clients buy and sell homes. We help them invest and build wealth, use all that equity that they've spent so much time and energy and hard work building with their properties. And instead of just buying and selling, they can take some of their equity, they can take some of their savings, buy more property, be able to capitalize on what so many wealthy Americans have capitalized on, which is property. And it's a lot. It can be confusing. It's overwhelming. Even buying a house is overwhelming. So that's why today we want to go into what an investment property looks like, how to get started, really building equity. So just a reminder, our topic today is building equity and financial wealth in real estate through property. And we have our guest speaker on today. And just in case, I know most of you know who I am, but if you don't, if you're just tuning in, you're not familiar, I am Carrie White of the agency in Los Angeles, born and bred in this crazy real estate market from a family of investors. Started when I was very young, 18 years ago. I was only 15, just kidding. But I born and raised in Los Angeles. We own several properties. We own short-term rentals, property management, and our focus here today, and one of my biggest goals for 2022 is helping all my beautiful, wonderful, loyal clients and anybody here watching how to take opportunities through real estate. So our objectives today are to talk about how to get started, the pros and cons, what it looks like, the nitty-gritty of it all. And we'd love you to keep your questions coming. So please feel free to give us feedback, questions, and right at the end we will do a little Q&A. And don't worry, because Jonathan and I are both here afterwards to help answer any questions you have. So we will make sure you have our email, best way to contact us, which I know Jonathan would agree with me. It's basically everywhere and anything. We will take pigeon signals, the whole thing. So,
I'll take some pigeon signals, yeah. Sure.
So just to introduce our guest speaker here today. This is Jonathan Greene, and he is a, hold on here. Did I freeze? No. Okay, so Jonathan Greene's out of New Jersey. He has a lifetime of real estate experience in every area, plus he manages a real estate team, which we all know is much different than just managing clients, really teaching, inspiring other agents to be great agents themselves. He is a lifelong real estate investor, and he's also a coach in business and life, a very well-rounded individual, a family man, many other things. So hello, Jonathan. We'd love to, we're so grateful that you're here to share all your knowledge, and we'd love to hear a little bit more about you and welcome you on.
Yeah, thanks so much, Carrie. Thanks again for bringing me on. I appreciate it. Great to be on a webinar together. I have been investing my whole life, and similar to Carrie, I grew up, my dad was a real estate investor. He was also an attorney, but he spent all his time playing with real estate. So from a young age, I was inside foreclosures, going to tag sales. My dad was offering on every single house at every single tag sale. I was just trying to get a football. I don't know what the big deal was, but as I got older, I was investing early. I started investing at 18. I had properties before that were put in my name that I learned about. So from the fortunate aspect, it was great that my dad taught me everything about it, but I don't think that you need to have a history or somebody who pushes you in. Anybody can be a real estate investor. Part of what I do is counsel investors on the best way to do it, and sometimes to slow down because it seems very attractive, but we want to make sure, like Carrie said at the start, if you're going to take your equity and invest it into something, that it's a good vehicle for the future, and then you can turn 1 into 2, 2 into 4, and go like that. So I have done every type of investment. I was doing short-term rentals with my sister before Airbnb, where we were on Vrbo and HomeAway out in the Hamptons, and I've lived in California as well. So my sister lives out in California in Carlsbad, so we've invested in that market as well. So I'm really happy to be here, and we do a lot of investor events. So We do 4 a month. Those are just counseling investors on the best way to use their money safely, really.
Great. Okay, so we could all tap into that too and listen along to Jonathan's monthly real estate investment webinar, which is very, very helpful. You know, a lot of this is rinse and repeat, as we were always told. You may hear it once, but don't fear if you need to hear it 10 more times, because it's a lot of information. And that's why we constantly try to give this knowledge out to people on how to get started. And every real estate investment is so different, whether it's the location, type of property, whether you have partners or not. So just know that there's a lot of flexibility with what you're investing in. Well, truly, there's never been a better time to be in real estate or to own property. Truly, you know, the opportunities out there right now are endless. To cash out on equity, to buy multiple properties, whether it's a single family, a multi-unit property, a short-term rental. You know, Jonathan, where should we advise anyone watching here today, you know, where to start? Like, okay, maybe I've bought a house recently or you know, in the last few years. Where do we even go to get started?
Yeah, I mean, I think it really depends on the goals. And sometimes people's goals are like quick. You know, there's different ways of investing. You can invest for cash flow, which is going to bring you money right away. That's going to be a different type of investment than if you're looking for something that's a long-term asset. Like in California, it's very hard to get cash flow on larger value properties. Cap rates for commercial type mixed use are going to be very, very low compared to what people think. But your appreciation value and potential for future gain is huge. So I think it's really about identifying first what you really want to do with your money, also what your risk tolerance is, and then how much you want to be a participant in that vehicle. Some people want what they think is passive investment. I don't consider anything in real estate to be passive. Even if you have property management, if you let them make all the choices, you're losing money. So it really depends on what level you want. I think that if you want passivity, you have to pay for it, and probably too much. So I think upfront, you really want to know like what level of involvement do you want? And then you can consider other things. There's syndications, and there's also investments where you're not really, you know, you're a limited partner. There's other general partners making the decision. But I think for new investors who, you know, want to get their hands dirty, there's a lot of different options out there depending on how they want to use their equity.
I see. So really deciding your level of involvement up front is one of the biggest ways. So whether it be you handling it, partners, or letting someone else take over.
Yeah, and really knowing, like, everyone needs to know what their financing vehicles. If it's cash, great, you know what you have to offer, but then it's how can you best use the cash? Do you want to use the cash to make more cash, or do you want to use the cash to sit and make an appreciation play, which long-term will make you more money? I've always been an appreciation investor. I don't really worry about cash flow. Again, it's fortunate because I was able to do that, but I still think appreciation potential is always what I'm looking for. And the one thing that I think that I do that's a little different than people getting started because they're so hungry to get in is I'm always looking at the asset. And I know later we're going to talk about like calculations and how to do it. I do very little of that because I'm focused on areas, assets, what it can turn into. Sometimes it turns in quick, you know, and people say, you were saying like, this is the time for real estate. And people are saying, oh, the market's too hot now. Well, they said that at the beginning of the pandemic, and now those people are up 20, 25% on the properties, more in California, even on that. So there's really, every time is a good time to invest, as long as you know what you're doing and what your target metrics are, where your money's coming from, and what your goals are.
Yeah, good point. So speaking of looking at long-term appreciation versus cash flow, that is something my father also has taught me about. What do you think about it? What do you think the primary differences are between that, and why would you focus more on long-term than the short-term? Because, you know, there's places you could go out to, you know, Tennessee and so many different areas, not really Arizona, but I know so many Nebraska people they're going because the property's cheap and they're turning income really easily, but the property's not gaining the value that it would say, you know, in major cities. So what do you think the pros and cons are of long-term versus cash now?
Yeah, great. And super helpful for anybody listening. I mean, I think, you know, cash flow is really to start. A lot of people are looking to transition out of whatever they want to become a real estate investor, or they want something else that's going to create income that they can count on, that they can add to their income, that they can pay for whatever things they want, whether it be for their family or for toys. It gives them a better idea of, well, I can count on this rent coming in and I want this to add to that. So I think if someone's looking for that, and it's really that type of vehicle, like to me, if I'm investing in stocks, I know I'm just going to wait and it's going to sell and maybe get some dividends here and there, but that's a long-term play. If I wanted something cash flow, I would be into rentals. And that's specifically why, as you know, short-term rentals are so popular now, because the money really comes in. But also with both of those, if you want cash flow, the management is high. You know, to do Airbnb or short-term rentals the right way, you either need to have a full team in place and you can't afford to make a mistake. And it's really the same with cash flow investing, because if you're only thinking about the cash flow and you see it and you're like, okay, I'm going to make $400 a month, but you don't think about the upkeep of the property, then a furnace breaks and you have no cash flow for 4 years. And that's why some people end up in turnkey. So then if you take that and compare it to appreciation investing, to me, that's being able to let your money marinate for a while and watch the market. And I think that to me is, I wouldn't say it's the more speculative, but I think you can just do better by identifying neighborhood trends and seeing where people are starting to flip, and then where is going to be the next spot. I always go to the next spot because I feel like I want to let it sit. And if you just look at what people are doing now, selling their homes, and you look at what they paid for them, they picked the right time, and that makes it a good time to sell, which I think is anytime the market's hot, I'll sell anything that I have to do, because I can turn it into more properties.
Yeah, so that brings up two questions. One is, when you're looking for longer term gain, does that mean you're usually looking at 5 to 10 years, or are you just looking as soon as maybe it hits a certain price point to reinvest into something else? And what type of income do you like to look at when you are looking at something that's long term? So is there like a certain number, your percentage you're trying to make over your cost per month, mortgage, insurance, all that?
Yeah, I mean, I specifically don't use any like hard lines on it, but what I am looking at is when I think the market is like topped out. It doesn't mean that it won't top out again. Like that's what we've seen in the pandemic. People are like, wow, I've made so much, I'm going to cash out. And then the next person could actually already cash out now, but that's cool. Then both people win. I don't always have to be the biggest winner in the race, but when I feel like, wow, I didn't think it was going to get this hot, that's when I want to sell. And when I'm looking at it, I always want to look. To me, if I have an investment, I want to be able to, whatever I'm going to do, sell or refi, whatever it's going to happen, I want to be able to turn one into two, whether it's one door into two or one property into two. If I've doubled my money on a single family because I waited long enough, I want to make sure I can go and turn that into multiple properties or other forms of investments that work.
That makes sense. So in speaking to that, with equity, how right now you can take out 50, 100 out of a property, which I know back in 2005, 6, 7, that led a lot of people into foreclosure, short sales. And so where is the understanding, because you can build a portfolio and an empire on your equity, what advice do you have to people to do that in a safe manner? Is that something you've done? Do you recommend it? What are your thoughts on that?
I think of it as stashing. I want to stash as much equity until I feel like I can take some of it, not all of it. Leverage is great. I mean, if you go back to Rich Dad, Poor Dad, which almost every investor has read, he talks about good leverage and bad leverage. Good leverage is great. Bad leverage is really bad. And so if you choose at the wrong time to use your equity, I've never taken a HELOC. I've used other forms of line of credit against assets, and that's what works for me. But I always tell someone, if they say, well, I'm ready to tap into my equity, well, what condition is the property in that you're taking the equity from? If it's not at max value, then I would complete repairs and make sure whatever I'm using as the asset to take equity from, that I know I'm not going to have to worry about it. Because the worst thing is to take a big chunk of equity from your primary residence and then realize like the roof breaks and now I got to put a $20,000 roof on that I didn't expect. And now I have another piece of leverage out. So as much as leverage is great, I've always thought of it as like, that's 2 loans, you know, and then it's 3 loans, and then it's 4 loans. And a lot of people will go up to 10 loans and more, which works. But if you're a cash flow investor, that's very, very dangerous, because one major repair if you have 10 single families, one major overhaul is going to kill short cash flows on all of that, which is why I'm always, even if I'm cash flow investing, I'm still looking for something that's also going to have the appreciation. Getting both is, how you make the most money.
That is huge. So that's a good tip for our watchers, listeners here today, is if you are going to be taking equity out of a property to purchase another property, make sure that it is in an appreciating market so you don't get stuck.
Yeah.
And another thing one of my business coaches had told me is if you are using, as I said, I don't want to tell all my clients to pull money out of their properties because they could, end up upside down. You can only do that when you can afford to make up that difference. So if you have savings or stocks and something were to happen, if it's not an appreciating market, you have to know that there is, a downside to that, because it is a way a lot of people build their wealth, especially in an appreciating market. They take from their house, they start on one property, a year later, they refinance, you can roll those costs into the loan. Your rate could be lower if it was last year, then you buy another property, same thing a year later. It's a really slow, as long as you're in good markets and as long as you have the backbone with other, I think, with your liquid in other ways to make up for it.
Yeah, I agree. I mean, I look at my portfolio of real estate just as a stock portfolio. I want it as diversified as possible. So my overall investments are diversified. I love real estate, but I don't just invest in real estate just for that reason. I think real estate is always an asset that is important to anybody's portfolio, because my sister and I would always talk about growing up, if everything goes crazy in the world, then of course we have a pandemic, and you're like, oh, things like this could happen. We still have real estate that we could move into. If everything happened, we lose our jobs, something bad happens, this is an asset that you have land first, and then you have a house on the land that you can use. So to me, it's much more tangible for me. And I'm able to evaluate it better. If you're trading stocks, you're judging based on, things that come out in the news or research that you do. I can go see a house and understand. And that's, I think, one thing that newer investors, especially from California, prices are so high. So they're looking into out-of-state markets. But to develop a strategy for an out-of-state market is very, very important that you know the funnel that you build, or else you're going to be too detached from an investment. And why make a big investment that you can't, touch, see, smell, which I think is really the way to understand, real estate overall.
True. So speaking to that, are the majority of your investments, I know you said you have some in California, majority of them are within your area?
No.
Okay.
I mean, yeah, over the year, I like them to be closer, but because I've moved around a lot. I lived in Florida for 14 years. I lived in California for 4. I've been in New Jersey. I grew up in Brooklyn. So I've also developed funnels where I'm comfortable if I'm doing out of state.
Okay.
But yeah, most of my properties have been within reach or within my sister's reach. Our Airbnbs were a little different. We had a different strategy. We never looked for outside property managers at the time. This is before Airbnb existed. So we would basically invest in areas where either one of my sister's best friends lived and they would manage the property. And then we had a better relationship instead of going into a market where we don't know anyone. So I always encourage people to really, if you're looking to invest out of state, which again, if you're just scrolling forums on Bigger Pockets, everyone in California is like, oh, I don't want to pay these prices, but I'd like to get a set of assets. And developing the funnel outside of that is important. But a lot of times, if you just make a list of every place you've lived or gone to school, and then you make a secondary list of all the places where my closest family and friends live, if you take that list and compare it to hot markets around the country, there's often overlap. And then that gives you a little bit of a competitive advantage to choose, like, say, your sister lives in Knoxville, Tennessee, and that's also a good market, then you have someone on the ground who can actually look for you. So you're just hedging your bets into having a couple people in a funnel that you already know.
True. That is great. I didn't even think about that because we've been looking to invest in other areas, and where we are, in LA and in the desert, we can easily get there, but we want to go to Miami. We want to go to Mammoth, Arizona. And I'm just like, who are we going to trust to go there? But that's a great tip to look at where people who can help you. And as you mentioned earlier, the property management side of things does change things. Even when you get a property manager for just a single family home here, I mean, it's a lot of money for things you don't really need, but that's a great little tip there.
Yeah.
And then, so speaking of investments, kind of to make it a little more basic, what are the different type of property investments one could buy? I know we talked a little about short-term rentals, multi-units, but let's kind of get a little granular there.
Yeah. I may miss some because there's so many different vehicles now.
Okay.
I mean, your traditional is going to be buy and hold, buy a house, hang on to it, wait for it to appreciate, sell it. That can either be live in. And to be honest, I'm one of the few investors, my best deals have all been on houses I've lived in, because I know how to buy a house. And I also I like to live in a nice house. It doesn't have to be super expensive, but I fix things, flip while I go. Then there's your traditional fix and flip, which is you're just going to buy. A lot of people are going to buy with either their own cash or hard money, flip quickly, and then sell for a profit. But a lot of people have lost a lot of money on that, because especially now, if you don't know what you're doing, building costs are high, supply chain is really, really tough. So you're adding 3 months onto a process and maybe 1.5x on what you thought you were going to spend. You have your BRRRR model, which is buy, rehab, rent, refinance, repeat. And that's really for you're going to buy a property, fix it up, put the renter in, then you're going to refinance out at a higher level. You're going to be able to cash out and leave zero money in the property if you do it right. And then you're going to take the money that you just took out and then do it again. And that's why the BRRRR model works so well. I am a proponent of what I call reverse BRRRR, which is holding longer and letting money marinate. So it's, if you can wait on a property, you're not going to rehab it first. You're going to buy and rent. Then when, say it's 3 years, tenant lives there, tenant moves out, then you're going to do the rehab. Then you're going to refinance or sell and then repeat that. That just requires you leave the money. But that's where you can buy into existing tenant relationships that maybe the rent's not perfect, but they're good tenants. And you're just going to let it cash flow at whatever it does. It doesn't have to be a huge amount. And then just wait until they're ready to move. It could be 5 years, but you're going to bank the appreciation in that.
Yeah, that's a great strategy. So you've got your fix and flip, and you said BRRRR, is that what it's called?
Yeah, buy and hold, fix and flip, BRRRR with 4 R's, and then reverse BRRRR. You have your short-term rental, which everybody loves. We obviously love as well. I will say that it's much harder than people think to do short-term rentals. It requires the most upkeep and the most smarts about what you need to provide as an owner, because I don't stay in hotels. I've stayed in short-term rentals for like 20 years because I like houses. I like to have laundry. I like to have a kitchen. But like, you could get a bad review in a short-term rental because you only had like one colander. Like, this is just how you have to think way, way ahead, and you have to have a list for everything. And for me, someone who does not like to get phone calls, when I'm doing Airbnb, I make sure that I have a system of management that works.
Oh yes, I'm doing another webinar on Airbnbs, because it is nothing like what people think. And the amount, I mean, the amount of questions you get, like the knives aren't sharp enough. How do I turn off the AC? Like, just,
well, so people are going to think this is crazy. So my sister helped me. We developed a strategy together. The one strategy that I have for Airbnb, and people who book on Airbnb are going to think I'm crazy, but it's not. If anybody asks any questions that are already contained in the listing, I immediately decline. Because amazing. Those are always the people who are going to leave a bad review. They're going to leave like a 4-star thinking it's good, saying like, well, it was good, but we only had 19 rolls of toilet paper and we needed 24.
Oh, yes.
So but I also have to hold myself accountable to know like that my listing is perfect. That I have everything. It tells them where to go. It has the restaurants. But as an Airbnb landlord owner, who's going to be a pain. And if they show you they're going to be a pain, it's no offense to them, but I just don't want to get all the questions when they're there. When I go to an Airbnb, I read the manual, they never hear from me, unless they should hear from me because things are broken.
Yes, exactly. Yeah, our manual is bulletproof. We're gonna use that. The questions, as soon as they say, how hot does the spa get? I should immediately be like, I'm not renting to you.
Because that's the same person who later is going to call you and say, it's only getting to 92. You said it gets to 94. And you're like, I mean, really? Like, it's the same. The level of care. If I read it, and you see Superhost and it's all good, like I just show up and I enjoy the visit. I don't want to see them. So you have to balance. And that's also, I know my personality, and I do not want to go back and forth. Maybe somebody else as a host likes to be that and is on site more. If you have an ADU in your backyard and you can really be there, maybe it's okay for you. But I know myself, and knowing myself as an investor means knowing myself as a landlord, short-term rental owner, and knowing what I'm willing to take on. And that's what helps me get, at least for me, better guests. But that's short-term rentals. There's other avenues. Well, I'll just give you a couple more.
Right. Yeah. The short term
Yeah.
is a whole different, ballgame. But
Yeah.
yeah, a couple more would be great.
Yeah.
Like,
So there's also turnkey, which is generally, there's a lot of what I would call quote turnkey companies that are advertised. And it just means buying an asset that's already been renovated and is ready to be rented and cash flow, usually buy
okay.
into the property management company. There's
I
a
love
lot of,
that.
quote good deals in the Midwest on these where you can be buying, at 100 to 200,000 and your rent looks good. There are a couple drawbacks. I think that turnkey solutions are good as part of an overall profile, but like for a new investor to invest in turnkey, just kind of boring to me. You're not going to learn anything. You're going to be paying someone to do all of the stuff, and you're going to be checked out. And you don't, what happens in turnkey is the cash flow is usually not that big. So if the renovation is imperfect, which sometimes it is, sometimes it's not, you're going to get a repair that you didn't expect, and it's going to just kill the cash flow. And the only point of the turnkey was cash flow, because remember, the turnkey you're buying already at its highest price because you're buying a finished project. So
Right.
your appreciation is going to take a while on these. Those are usually straight cash flow, kind of done assets. But like we said in the beginning, that's definitely just a cash flow play. And the cash flow honestly is not that great because you're buying it at the highest point instead of doing a DIY, yourself.
True, true. So maybe a turnkey option is for somebody who's just starting to get their feet wet, maybe doesn't want to take too big of a risk, but also doesn't have the biggest upside coming back to them.
If I was new and I wanted to put money, I'd probably look for a verified syndication, which is investing really in somebody else's investment, and you're going to get dividends over time for that. The problem with turnkey is that it's still a one-to-one. So you're paying a property manager to run and rent your property, and so many things can go wrong. And look, there's good property managers, but there's a lot of bad ones. Just like there is, same for us as realtors, where everyone's not great. But if I'm putting any money out there into an investment, I like to have more control. So I think for first-time investors, giving up too much control is often a mistake. At least in a syndication, you know that you're a limited partner, you know you're going to get the payouts, and it's kind of, you're banking on the overall larger asset class. It could be like an apartment building or a complex. So you're involved in something, but you don't really have to participate.
Yeah, I mean, there's so many different types of investments, which I want to jump into one question based on what you said. But quickly before that, when it comes to a house, like some people like to keep the condo or house they're in when they move up, or buying multi-units, whether it's 2 or 3 units.
That's where I was going, right?
I've always been a proponent of buying 2 to 3 to 4, or even bigger if you can, because vacancy factor, right? And plus multi properties increase at a higher level than single family. But what are some of your thoughts on that?
Yeah, so we work with a lot of multifamily investors, and it scales. You hit great points. I mean, one, you're your traditional new investor who wants to house hack, which is buying a multifamily, living in one side, renting the other side. Super popular all over. We're helping lots of people do that. But you're always trying, when you're doing that, you want to be living in the smallest unit so you cash flow the most. So if you look at a multifamily that's a 2/2 and you only need 1 bedroom, you're actually losing money, in my opinion. So we have a lot of people who will house hack and live in a basement unit, cash out on the 2 above. But then as you scale forward, you can actually house hack 3 and 4 families. And I think an important thing to remember is 4 families and below are residential real estate. So when people talk about cap rate, they do not apply to 4 and below. It may give you an idea of the income, but that's not, it's going to be judged on appraisal against other comparable sales of 2, 3, 4 families. As you get to 5 units and up, that's a commercial product, which will be judged by cap rate. And when you get to 5 units and up, it's commercial loans. So there's less players in the game. So if you can get to 5 units, you're going to get much better deals at 5 units and up. And it's why in California, you'll see a lot of people buying at what people think are low cap rates, like 3.5 on the cap, or even 4 or less. But the asset class is amazing. So you're buying into an asset, and those are the big differences. I think a great scale is to go from single or start at a house hack for a 2 family. And then once you know how to do a 2 family, maybe you can do a 4-family. And like you said, one of the great thing that you just mentioned is the vacancy part. The more units you have, it's the more management, but then when one tenant stops paying, you still have other units paying, so you're still going to cash flow. When you have a 2-family, you house hack, so you're living on one side, the other person stops paying, you're in the minus and you're you're losing money. And if you're tight and you don't have reserves, which is really important, you're in trouble right away.
Yeah, and that's something I always try to advise my clients, is not to keep what they have and move into something like that, house hack, at least 2 or 3 units, and yet then prep themselves to get into the longer term, the big boy, big girl arena, which is commercial property. And, just to understand that the way it's classified, 1 to 4 units, you're in a residential category. So your loans are different. When you get over 4 units, 5, since it's considered commercial, you do have more opportunities for zone changes, adding retail. There's a lot more opportunity there. You also can get your loans based on the income and not necessarily what your income is. So it is really the big players club, and it's super exciting. And look, vacancy factor there. A lot of these people run having 2 to 3 units empty at all times, and they actually prefer it that way for a variety of reasons. But it definitely is a game changer, but it's slow progress to get up there. And all these investments are great as you're building your portfolios.
One more thing on commercial, because I think it's important now. We just went through a pandemic that hurt commercial real estate a lot. You're seeing tons of commercial buildings available. So for me, my 2022 target is mixed use Main Street commercial, because like in a lot of towns, Main Streets got hurt. There's a lot of vacant spaces for rent. To me, when I see vacant spaces for commercial rent, that means somebody might want to sell. So those are properties that I look at. And if you're a cash buyer, you have huge leverage in the mixed use commercial game, because if they are unrented, the commercial loan's not lending on it. So because they're going to go on a cap rate, an existing cap rate of rents coming in. So if you have 4 units and 3 are vacant, that's a cash buy, or someone has to use hard money. So you can really leverage to get good deals, which is what I'm trying to do now. And I also think that the upswing for Main Street commercial is huge, because now soon everyone's going to be like, oh, okay, maybe I'll go back into a retail space. And that's, mixed use is cool because you get commercial, which is going to be longer rents. Maybe it's retail, doctor's office, lawyer's office, whatever. But then you have residential. I love the split because I like having tenants. You can kind of earn more money. It's going to be a little bit more upkeep. And then you have commercial, and commercial, everyone who has a commercial rental property from you, they have to keep the business size, the face of their business. So they're going to upkeep their business much better than somebody who's living, in an apartment in the back that nobody's going to see, and it's not their storefront.
You're right. Speaking, great points. Speaking to that, with the pandemic and how commercial has been impacted, and also, the rental moratoriums right now in LA, they've still extended that rental moratorium. You're trying to buy more of that. Is that because you see things getting better, or where do you see the future of that space?
Yeah, I mean, it depends on the area. Like where I live in Morris County here, and if I just look at my town in Mendham, I look at it and Main Street can be better. And so I look at that for all towns, and I look what's happened to Main Street. There's other towns where they're still thriving. But to me, as an investor, I'm always looking for what could be, because I'm willing to put a little bit of risk on my own knowledge. And if it doesn't go right, I'm never paying too much where I'm going to lose, because I'm a tough negotiator. So I'm only going to buy something if the property makes sense for me. So say I buy something on Main Street and it doesn't go the way that I thought, I still have an asset. And I always use the word asset because to me, real estate is all assets. I know I can repurpose it into something else, which is what is so cool about short-term rentals now. When you have residential units, maybe you buy a multifamily and you think, well, I'm just going to rent it, but then your long-term tenant leaves and you realize, well, I live near a hospital. Travel nurses are rich right now. So why don't I just rent Airbnb to travel nurses? Because travel nurses are great right now as tenants for Airbnbs, because they're getting paid so much money so they can rent a really nice place and they're never there, which is good for you as a landlord, less wear and tear, and they're just busy. So if you take all the things that we just talked about, you can be using these strategies together on a lot of properties. And I always think that you need a backup plan for everyone as a just in case this flip doesn't go well and I'm too high and the market goes down, I'm just going to rent it. and you have to know
backup
what you can
plan.
get for that. Yeah.
Yeah. So really a good point there to note is how much opportunity you have within all of these assets you're buying. So whether it's getting rented in that moment or it's being impacted by something going on with the market like COVID, you can repurpose those spaces and find, like here in LA, there's a lot of people that come in for filming. So they need to stay somewhere, producers, everybody involved with that coming in to film. So you could do short-term there. The nurses are always a big thing. So you've got a lot of people traveling back and forth from San Francisco, New York right now, because LA is a big hub for Silicon Beach down here. So whatever market you're in or area you're in, you can really look at all the different avenues of how you can use those spaces on any investment. And, even the buy and hold right now, we have investors that are buying property just to hold it because they're making more money in 6 months to a year than they are in any other investments, let alone, definitely not stocks or crypto, because those have all tanked. But, real estate itself is just leveraging against everything.
Yeah. Real estate to me is, again, because it's tangible. I know I'm not going to go down 100,000 in a day, I know the roller coaster of crypto or stocks. I'm just going to stay on the roller coaster.
Right.
For real estate, I'm always studying around what's happening. And that's how I'm always picking areas. I think most people, if they're new investors, they say like, oh, well, what are the 10 hottest areas? I would never invest in the 10 hottest areas. They're too hot, because I'm definitely paying more to get in. You can still do well, but what if you looked at the hottest area and then tracked 2 towns outside of that and waited 2 years? Because then you can see, I always draw a circle around the hot area and then look for 2 towns in all directions, and then look what's happening. Have they started flipping in one area? If not, maybe I'm going to take an educated guess on that to see. And then there's also city investing, which is very, very difficult. This would apply to LA. It applies to Philadelphia, New York City. Cities can transition so much quicker than the suburbs. So if you don't know what the average pay scale is or income is for each area, like in Philadelphia, we're just moving the block numbers to see. You can have a 1 block decision that could cost you $100,000 in a year just by not knowing, where gentrification trends or where parts of cities are going to resist gentrification. And that's why people who say like, hey, I just want to invest in real estate, there's a lot more to know to be good at it. It doesn't mean that you can't kind of passively do it, but if you're doing it, you really want to trust the system that you're giving money to, because nobody wants to lose money. And I think you want to, at least I like to coach newer investors to learn more about it as they go in, at least become a participant, because that's how you're going to get to the part that everybody wants, which is what they consider passive income, but it's really long-term cash flow from making good decisions on assets.
True. So that's a good point, that getting aligned with trusted advisors who own property can give you the advice on all these different types. And whatever level you are at, whether you're just getting started, already have 1, trying to move into 2 or 3, having people that you can trust that know all the different ins and outs, the opportunities, and can tell you, hey, that's too hot of an area, or this area may not become what you think it is. But that's a great tip about looking close by. Like right here, we've had downtown had really gentrified a lot, and there's a little town called Boyle Heights next to it, which wasn't quite there, but we were watching it. I have a couple of clients that invested there, and just in 2 years, they'd made 300,000 because it just, boomed. And that's, a few of my other clients in like the West Adams Mid-City area, a lot of people go through like, I don't want to live here. Yet these areas are the next. Oh yeah. Now these places that were going for 500-600 2-3 years ago, they're now at 1.3, 1.4.
Yep.
You can't get a property over there.
That's how the long-term investors make the most money. It's always a choice and a little bit of educated risk. So that's why it's hard to just throw out money as a new investor, because your educated risk can lose you money, or your trust, like you were saying. I wouldn't say I'm very trusting just because I've been in real estate, deals my whole life, but I like to work with people who I know have the same leverage. So if I don't love partnerships, but if I'm going to do a partnership, I want us both to put the same amount of cash into the bank. I don't want one to be the work and one to be the cash. It's not an equal relationship. It doesn't work as well that way. If you work together for years, you have a relationship that works, but like for new people, partnership should be fully equal, fully paying the same things. And also knowing, remember, if you have a 2-person partnership for a real estate investment, somebody has to break the tie. So you have to agree in the beginning, like, look, if we can't agree, what's our system? It's not going to be rock, paper, scissors. That's not going to make you
Right.
money. But
Yeah.
that's where partnerships go wrong. And they go wrong in real estate all the time.
Partnerships can be very tough when it comes to investments, as far as, say something happens with the roof, or you need to upgrade windows. What type of windows do you want? What materials on the roof? Who do you want to use? Maybe some people don't feel it's worth to invest there, or maybe it's time to sell or refinance. And partnerships are very tough. You
really have to know in the beginning, do we have the same tastes? Because for me, if I know what the after repair value is, which is ARV in a flip, I know what I can spend. So when I'm looking at things, I always am like, well, that looks just like $399 tile and $799 looks the same. I'll use a $399. It looks exactly the same sometimes.
Yeah.
But if I'm doing something specific, which I like to do, I'm going to spend the money on that, knowing that I'm banking on myself to do well later. New flippers don't know how to do that generally. And sometimes they're maybe picking for themselves or picking for the money and not thinking of an overall design. And that can hamper your long-term investment a lot, even in hot markets. I mean, it really can.
Right. That's true. So for anybody watching who's thinking about partnering with someone, I'm not saying don't do it. It's a tough way. And there's ways you can partner with people by getting equity, doing HELOCs, going to do a hard money loan. So there's ways to partner, but where you still have the sole decisions, or go through a really strict game plan. If this, then what, then that. But it's hard to know all the things that could go wrong unless you are aligned with an expert who can say, here's all the reasons a partnership could fail, even things outside your control. Like, what if they were getting a divorce, or
exactly,
something tragic had happened, then everything falls apart. But
and real estate in general is unpredictable. Not the actual real estate, but the process of renovating or fixing real estate. You open one wall and then you find mold, and then you need to go do a mold remediation. So there's always, everyone wants to always, blame the home inspector or blame the realtor. Like, how could you not find that? Well, it was behind a wall. Like, some things you just aren't going to find, and that happens in every house. So every renovation or every investment, you have to have reserve funds on hand to just account for things. Maybe somebody lied about what happened, but like, you already bought it, so you have to move on and figure out. And I think if you're too rigid about real estate, which I definitely had been in the past, you're gonna make it harder than it has to be. You have to give yourself enough leeway to know things will come up. I know what I can spend. Like, I just put a flip on the market. I knew how much, when I'm spending the money, I'm like really annoyed every day. I'm like, what did you just say? 28,000 in foundation work. I'm annoyed. But then I look at what I think my after repair value is. This is just part of doing business, but you have to, keep doing it to understand how not to freak out when weird stuff happens in real estate, which is all the time.
Right. Which does lead me into a question about pros and cons. But quickly, I just want to remind everybody, we will do Q&A in a few minutes here. So type in your questions so we can answer them. I know we've got quite a bit going on in the chat, which Bev is helping me monitor. So I'm so intent. I'm learning so much even after all these years too. So that does a quick question. What are some of the, pros and cons, or lessons, or any way you want to wrap that into a quick answer? Pros and cons, learning lessons.
Pros are definitely tangible asset compared to other asset classes that can fluctuate more, that you can't hold and touch. I always say, like, touch, smell, because it's important. Like, real estate is, you have to learn things about it really before you invest. So for people who are looking to invest and they're just looking, out of state on the computer all the time, and they've never seen houses, you'll have no idea what the 200,000 that you want to spend is actually buying unless you've seen it in person. So even if you want to do out of state, you have to see it in person, because real estate is tangible. You need to see houses, whether they're in this area or not, but you still have to know, how much is this going to cost? And that can be different in each market. For cons, I think it's the kind of allure of being an investor right now. I think everybody thinks it's easy, just like people think it's easy to be a real estate agent. Oh, this will be no problem. Here comes all the money from the sky. It's not like that. For all of us who do agent or investing, we're hustling all the time. And to be a good investor, you have to be able to analyze data and figure out who you can trust. So the con is really the people who want to say, people say like, oh, I want to get 100 doors in the next year. I always say, why? That sounds annoying to me. Like, I don't want 100 doors. That's 100 doors to manage. I'd rather
Yeah.
have 5 doors that make as much money as those 100 doors than the 100 doors, you know, to me.
Right. Yeah. I mean, we as a society, we're in the Amazon now. We want instant gratification. When it comes to investing, set your goals, but it's really about slow and steady wins the race there.
Yeah, one thing that you brought up, I just want to hit on before we go to the Q&A. It's really important to be in investor communities and to meet other investors,
Yes.
know people who've been doing it a long time. We developed 4 meetups like 2 years ago, and within just our New Jersey and Philadelphia meetup, we did like 70 deals last year. And
Right.
those are, a lot of people get to the meetup not knowing, but then they see like, oh, wait, all these people are trying to house hack. I can definitely do it. Like, they're learning as they go. You are going to learn the most from other people who are doing it, who have no agenda to try to get it. Obviously, as an agent and a team leader, I'm going to end up getting business from these type of things. I never ask for it because I don't care if I get the business. I want to help people, and investing, those are the people that you need to look for, who will give you free advice, respond to stuff. And the last thing I'll say is you need somebody in your investor portal who's willing to tell you no. And I'm unusually good at that, but everybody wants an echo chamber because it feels good to say like, hey, look at this investment. This is better, you know, and then you say, well, I mean, it's been on 300 days and every investor in your area has passed. So I really don't think as a first-time investor, like it's the one. There's something that you're missing. But everybody needs someone who's going to tell them no, because you get so excited to get an asset, especially in a hot market, that you can make a decision that will, again, take out your entire investing career.
Right. Which was a question I wanted to ask you is, how many investments come across your desk percentage wise do you say no to?
Oh, I mean, 99%. Yeah.
Yeah.
I mean, probably more, 99.9. And
Yeah.
that is a lot of, you know, there's a lot of wholesalers in the middle, the numbers aren't correct, or I don't have a strict guideline. I'm more like, know it when I see it. And I think that's important. If you just run numbers, if you just run a calculator that will make a formula, nothing in anywhere in LA or New Jersey will work. The taxes are too high. It won't make sense. You have to understand the asset. Maybe in the Midwest, if you know the taxes are low and there's no weather incidents, you can count on the formulas. But no, I say no to almost everything because I don't care how many doors I have. I just like good assets that make money long term.
So again, aligning with experts who can really give you some understanding of what the formula is, what to look for. And those formulas are different based on what type of property you're looking to purchase, where you are, who's involved. Yeah. So yeah, we'll get into a couple questions here. Someone had mentioned equity should have been taken out a long time ago, 6 months to a year ago. Rates were lower then. Is it too late? What do we do now?
I mean, now's a very interesting time, but I mean, I don't know, 10 years ago, what was cool if you got like 6%, you know? So to me, I look at it like rates were crazily low. Like, so a lot of people got good deals. So now that they're in the, you know, 4 to mid 4s, it doesn't really affect me. You know, I'm looking at the asset again and not the rate. Does it annoy me that they're moving up? And that may, you know, play a role in our business on market and off market? Sure. But there's always equity is a sliding scale. So maybe it would have been better if I could have repurposed the equity 6 months ago. But if I look at, I bought it for 250 and it's worth 450, I still like what's going on now. The market end price is still up, even if the rates are up. So I'm still banking money over the long term on the actual equity in the home.
Exactly. There is so much talk about rates going up right now, and it does impact buyers. But where, you know, a year or two ago, or 2-3 years ago, 4% was a great deal. 5% was a great deal. People were still buying.
I mean, our parents, we're paying like 7, 8, 10%. Like, oh, this is great. Everything changes. Like, as an investor, you're just looking at assets. The market can do whatever it wants. I'm still looking for what a deal is in whatever market it is. So if the market's hot, then I know maybe my deal's a little hotter, but if I know the area better, I'm still going to be able to win. Yeah,
no, I completely agree. So one of our attendees, Caroline, what's up, girl, asked, what do you look for in a property manager?
Trust. It's the most important
Trust.
thing. Yeah, at 100%. I want to see a backlog of other properties and I want to talk to other people who they manage, and I want no hidden costs. I want my property manager to feel empowered to make decisions, but there's a level where you cannot make that decision. It's usually a money amount, like $100 and below, you do whatever you want, fix whatever you want. Maybe it's a little bit more. Anything
Yeah.
over that, I want to know. But like, you hire a property manager to take the stress off of you and you pay for it. So if you don't trust them, you're not only going to lose money, but you're going to lose property value and you're going to lose a trust relationship. So it's always trust. And, these days, look, online reviews are fine, but I always would rather connect to a client and a good provider. If someone called me and said, hey, do you have a client that you work with as a realtor that you could refer me to so I could just ask them some question? I'd be like, yeah, sure. If a property manager can't do that, or they're going to send you to a fake family member, it's not worth it. Just tell me someone, I'll know if they're really a good property manager or not. It's a good question.
So online reviews, trust, extra hidden costs, and a little bit of flexibility. Some of these people only do things their way and their system, and it has to be flexible. It's not all black and white.
Right. Yeah. I think in order to get someone good in any part of real estate, you have to be clear about what you want from them, because it may not be a fit for everyone. So I have to say, this is what I want, X, Y, and Z. Is that something you do? I'd much rather them say no than say yes and then not live up to the expectations that I'm paying them for.
Very, very true. And just a reminder, you can find Jonathan Greene on Instagram at Trust Greene. That's Greene. And I am at Carrie Ann, which most of you know. We have another couple questions. Which is your favorite, Bev? The next one? What do you look for?
I like,
Okay, so what makes a good investment for you? What minimum ROI do you look for flips? Which, return on investment.
Yep.
And what numbers do you take into account to decide if it's a good multi to invest in? Good multi-unit, I guess. So it's a two-part question.
Yeah, I mean, good investment for me, again, I'll go back to asset. To me, I just look at everything. Like, I have to look at it. I also have to look at it and be like, I'll go there. Some people think a little bit too much about the money, and then they'll buy in an area that they don't want to pick up the rent, if they're not using, a system. In the old days, we always picked up. If you don't like where your property is, you're not going to care about taking care of it. So to me, even if you're using a property manager, you're much less invested if you're just looking at it as a money vehicle. So to me, I want an asset that I'm okay going and that I want to check up on and be a good landlord for. And then, so I am different. Again, I don't use calculators a lot, so I'm not looking for a percentage. I'm looking for an amount of money that I want to make on a flip. So depending on what my in price is, like if my in price is 300K, I want to make 50 or 60 on that, and I know I'm going to spend 50 or 60. Like in this one that I'm doing now, I bought for 465, and I put in our market, I put in like 180 to 200, but we're listed at 825. So I knew the whole time I have spread. We'll see where it sells, but it's in LA, San Diego, and lots of parts of California, you're buying in at 7 digits, and you have to know how much is my renovation versus how much is my spread. So I'm always focusing on not on a percentage, because again, so many things come up. I want to know how much money my best case scenario is and my worst case scenario is. And if my worst case scenario is still good, I'm going in, and that's how I judge it on that. And then
that's a good point.
Numbers for good multi depends on how many units, and it depends if you're house hacking. So for multifamily, the traditional calculation across the country is 1% rule. So if you buy it for 500,000, you want to be pulling 5,000 in rent. But like that doesn't work in New Jersey, doesn't work in California, because you have to pay in too high. So you're looking for an appreciating asset that delivers good cash flow where rents can go up progressively. But it's why things, if you can find stuff at 2% rule, it does work. But that you have to know, again, that's going to be long distance for us who are not in areas where you're getting 2% rule.
True. Well, we're almost out of time. I wanted to go over some of my favorite tips that we spoke about today. Some of the things I was writing down is the idea of, or the desire to go for an appreciating market versus the cash flow right now, or a little bit of a combination of the two. You can go to many areas. People are like, oh, I can't afford it in LA. I'm going to go out to Arizona or Texas or something. And, you don't see the return on investment as much. now, everything's kind of rising, having a backup plan. So not pulling equity out of things just to buy something else, making sure you have reserves or backup plan in place so that you're not, underwater eventually. Going 2 towns over from hot towns. I love that. That's one of my, the two town rule. Cities over the suburbs. Cities always appreciate more, and suburbs may not gentrify the way that we think they are. Partnerships, to be very careful getting into partnerships and having them be equal when they're partnerships, equal money going in. Being involved with meetups. One of the biggest catalysts to my career has been my mastermind group. Shout out to the BRE, and I'm in some at the agency and masterminds and all the knowledge from my family and my parents and that type of thing. I think having support in whatever it is in life, but especially when it comes to real estate and investing, and not from people who don't own property.
Yeah. Or they have something to sell you. Like, it's great if you go to an event, but if there's 9 hard money lenders, they want, to give me money at, a high percentage. I like people who are all in it for the same or who have no ask. You can know what we do, and then they can ask to do business together, but I don't want to be out there. It's obvious what I do. You can, go on Instagram, you can see what we do, but I'd rather just give the value. And I think in the investing circle, that's harder to find. So when you find it, small mastermind, local meetups, Zoom, you're just going to judge like who's real, who's going to let me just swing by a project to see what a flip looks like. That's super helpful.
Exactly.
But you can't just get that without building relationships. It doesn't work.
Yes,
like that.
Building relationships, reaching out. And there's a lot of different avenues to do this. Again, working with someone you trust. Speaking of trust, that was one of my last tips, is trust, working with property managers you trust and people you trust and meetup groups that you trust and lenders, your agents, escrow, all of that. So, that's a beautiful life tip and property tip to kind of end on. If there's any final words that you have, Jonathan, we are so appreciative of your time. This could be a 4-hour conversation. There's so many different avenues to go down. If you're just starting off here, if you're looking to build, as you can see, there's just so much opportunity in real estate. I'm so blessed for being raised in this real estate world and being able to keep adding in. And whether, you have a little bit of money, if you don't have a 20% down, you have 5%, you can still get started in a lot of these areas. So don't be scared to take the leap into taking advantage of this market. And you see real estate, it's cyclical. Whenever it goes down, it goes up higher than it did the last time. So, yeah.
Absolutely. Well, thanks so much for having me. I really appreciate it, Carrie. I think that if you're looking at it like over the long term, I agree. Everybody can be an investor. You have to just know why you want to be an investor. And if your why to be an investor is only money, you're going to make bad choices. It's not like we all like to make profits on it, but you have to look at how you're doing the assets, understanding neighborhoods and areas and what the goals are. Are you overbuilding in a neighborhood? Are you helping a neighborhood if you're looking in a gentrifying area?
Right.
These are things that long-term will help you make more money if you're just focusing on, again, buying assets that are going to help you. And then, like you said, you have to meet other people who do it. You're not going to learn anything from somebody who's talking about investing who hasn't done a bunch of investing and isn't willing to share numbers, data, and just say, like, come to my project. Like, I'll, show, here's the renovation list, look at it. More transparent, the more trust you're going to get there.
Yes.
Thanks so much for having me.
I really appreciate it. We loved hearing you talk today. And again, trust Greene with an E at the end, and we will send out information to everybody attended and everybody else. We have a recording of this and all contact information, and we're always here to help. And thank you for watching How to Learn How to Grow Equity and Build Wealth with Real Estate.
It's awesome.
Thank you, everyone. Great having Jonathan. We appreciate it. Happy Wednesday.
Thanks, Carrie. Appreciate it. Talk to you.
Take care. Bye, everyone. Do I just end it?